Good morning, Bitcoiners, and welcome back to your economic calendar, where we cover the news and analysis you need to start the week off right in Bitcoin. Today is Monday, June 21st, and in today's episode, we're going to spend some time debunking the Bitcoin death cross. We're going to talk about what it means and what has happened the last 3 times we have seen it on the Bitcoin chart. Second, we're also going to talk about the Bitcoin futures on the CME, where the implied bases on those contracts have reached record lows. We're going to talk about what that means and what the implications can be going forward. And last but not least, we're going to talk about all of the insights that we got from the Fed meeting last week for their Federal Open Market Committee meeting. There was a lot of volatility in the markets right after the meeting, and we're going to look into some of the comments there and draw some implications for the near and medium term. So grab your coffees. It's going to be a great one as always. Starting as we usually do with Bitcoin, we see that it was a volatile week where Bitcoin reached a high of 41,341 intra-week and a low of 33,337 to settle the week at 35,589, down 8.78% for the week. If we zoom out to the daily, we see here that Bitcoin essentially rose on Monday, peaked on Tuesday when the Fed meeting started, and essentially has been on a pretty much a straight line down since the Fed meeting. So again, we see how volatile the markets got after that meeting. Going back to the weekly, and we're going to talk about the death cross in a second, but I also wanted to flag there was a headline that broke early this morning, which is in the back of your screen right now, which was this morning, essentially, the Agricultural Bank of China issued a statement that prohibiting the use of its services for virtual currency transactions, and this has sent Bitcoin price lower. The market will likely remain on high alert until or as it awaits potential follow-on from this announcement. So again, this broke just a few hours ago, and it probably has quite a bit to do with the recent move that we're seeing in the markets this morning. Now, as we mentioned in the headline, there's been quite a bit of talk recently around the death cross in Bitcoin, and we wanted to essentially spend a minute to discuss what the death cross is and what it actually means for price, or doesn't at all. So as we mentioned, the price move that we saw, and I'm just going to take you back to the daily chart where where this is actually happening. So if you see what's happening right here, this bright blue line, and I'm just going to get rid of these other trend lines so that it's easier to observe. But if you see essentially the dark blue line here is Bitcoin's 50-day moving average. The light greenish or the teal line here is Bitcoin's 200 moving average. So as you can see, over the weekend, I guess on Saturday, the 50-day moving average crossed the 200-day moving average. This is what is deemed by many as the death cross. So again, although it has a scary name, we wanted to essentially see what has happened the last 3 times that the death cross has been essentially observed on the Bitcoin chart. So to do that, we essentially went out and looked at the last 3 times this had happened. And we're going to do this here live again, just so that you can see. We're going to find there have been 3 instances. The last one, there was one on March 21st. There was also one on October 21st, 2019. And there was one on, one second. Where is the... So let's start by going through these, okay? Here's one, here's the other, and here's the other, okay? So first, let's start with this one, which was March 30th, 2018. So March 30th, March 31st. So to essentially see what happened when the death cross was signaled, what we will do is we're going to measure essentially the price action from the day that the signal was seen and the following 30 days, okay? So as you can see here, I'm going 30 days out on the chart, and I'm going to find the close on that 30th day, which is here. And as you can see, 30 days after the death cross was seen on March 30th, 2018, Bitcoin rallied to the tune of 38.63%, okay? The next time that the death cross was seen, which was here, October 2019, if we run a line here to see where Bitcoin went the 30 days after, we see that Bitcoin, let's see here, 30 days. So as we can see, the 30 days after the second death cross that we saw on October 25th, 2019, Bitcoin dropped by 17%. And if we look at the last time that this happened, which was March 25th, 2020, and we run a line for 30 days, we see that the price on Bitcoin's 30th day after this was about 15% higher. So again, considering that Bitcoin has been higher 30 days after, for 2 out of the last 3 times that this death cross has been seen, we thought that it would be prudent to highlight that although it has a scary name, it is not necessarily correlated with negative price moves. So again, just we're going to go back to the weekly chart here, but now that we got the death cross debunkment out of the way, let's look at some other market fundamentals where we are still continuing to see signs of institutional activity. So what are those fundamentals? We want to bring your attention to the Bitcoin futures annualized rolling 1-month basis. So what this means in plain English is that this is the difference between the spot price of Bitcoin and the future price of the Bitcoin contracts on the CME. On the rolling 1-month basis, this is comparing the spot price to the strike price of the future that is 1 month out. As we can see, these levels, like the implied premium or the difference between spot price and the first dated month on the futures contract on the CME, reached a record low last week of negative 2.79%. That's a negative implied yield, meaning that the price for 1 month out future contract is trading lower than the current spot price. This is, as you can see, this is the 1-year chart, and it's essentially reaching all-time lows on the 1 month. If we look at the 3-month basis, we see a similar trend, and it's actually at its record low right now as we speak. For the first time ever, the 3-month future, the difference between the spot price and the price of the futures contract that is traded 3 months out on the CME is negative. So again, we're starting to see a lot of some backwardation on this curve, which is essentially what is happening here is that the institutions are essentially aggressively selling those contracts and buying spot. Now, what this tells us is that institutions are essentially happy to book a very small yield and even potentially a loss to participate on this trade. This keeps compressing the implied returns. So as we've covered in the past, the implied basis on the Bitcoin futures trade is a benchmark yield in the Bitcoin industry. This yield dropping means that there is more financing available and more liquidity in these Bitcoin futures markets. Over time, this should lead to reduced price volatility. More on what we can expect this week in our What's Ahead section later today. Moving over to the S&P 500, we see that equity markets also shifted directions on Tuesday last week after the Fed's FOMC meeting began. And to highlight that, we're going to look at the daily chart. So again, this is Monday, this is Tuesday, similar to Bitcoin, peaked higher and has been basically coming down until this morning, where we're seeing quite a strong bounce in the S&P 500, up 1.24% this morning. However, if we look at the performance for last week, it closed the week down 2.17% at 4,153 points. Now, looking at the price action, the S&P 500, this is Friday's bar where it was down 1.71%. As you can see from this bar, what it tells us is that the S&P essentially closed at the session lows on Friday, which typically means that there is some pent-up selling demand typically that carries on until Monday. We're not seeing that this morning, even though it was potentially likely after seeing the market close at the very low end for the session. Now, looking at the headlines that came out last week, as you can see from the back, there was a lot of attention around the Fed meeting last week. And the massive signal that we saw, or I guess in our view, one of the most important signals, was the fact that the Fed raised its inflation expectations for 2021 to a 3.4% estimate. Now, this is a full percentage point higher than its projections just a few months earlier in the March meeting. Now, remember that the Fed's target inflation is north of 2% to average 2% in the long run. In other words, the Fed's inflation targets are being met at the current levels. This should make the jobs and unemployment data the big focus for the markets going forward. As we know, the big anchors for the Fed are inflation and the unemployment rate. Now, looking at the Treasury yield curve and where it shook out after the announcement, what you're seeing in the chart behind you is essentially the current yield curve in a light blue compared to the June 2020 yield curve on the gray color. As you can see, almost in textbook fashion, today's yield curve has moved, call it a few years closer relative to 2020. This is making the curve steeper, as it should be when the market expects a rate hike in the future. Now, the rate market is pricing in higher interest rates right in line with the Fed's 2023 rate hike plans. And that is not a coincidence. Again, the yield curve dances to the Fed's music. That's typically how it happens. Now, switching to how this is impacting markets, let's take a look at the Russell 2000 index. And we can see that it dropped down quite significantly last week. Let's look at the weekly chart. Quite a bit. It dropped 4.20% last week. And it essentially lost that very important confirmation level that analyst Tom Lee from Fundstrat have been looking for. So again, interesting to see how this is rattling the markets. If we look at the NASDAQ, the NASDAQ actually reached a new all-time high last week, which is interesting because it's showing strength on the back of this changing rate environment. As we said, it did touch an intra-week high last week, new all-time high, and this might have something to do with the fact that the industrials and commodities trades seem to be reverting back to tech given the changing rate environment. Now, the week ahead is loaded with Fed activity, and markets can be very volatile as they continue to digest the recent Fed meeting comments. More on this on our What's Ahead section later today with a lot of the details on the Fed activity this week. Moving over to gold, we see here on the last week chart that gold took an absolute beating last week, down 6.04% at $1,763 an ounce. Now, as you can see here, it is basically back on the descending wedge chart that we had highlighted a while back, and this descending trend line starts basically all the way in August 2020. It seemed like it had snapped it quite confidently, but it has given most of those gains back and now sits squarely within that descending wedge once again. Now, the price drop that we saw is not really isolated to gold. If we look at what happened to the dollar index, we see that the dollar index jumped by 2% last week. This is a very massive jump for the dollar, and this hurt almost all commodities and industrials. If we take a look at what happened in lumber, look at lumber prices. Lumber prices are basically down from a high of $17.33 per contract to currently $852 per contract. So it has lost essentially more than half of the value that it had just under 2 months ago on May 10th. So impressive to see what's happening in in lumber. Again, lots of pressure in commodities. This has essentially spilled over into pressures on gold. If we look at copper, also had a pretty brutal week last week, down 7.32%. So again, this is not isolated to gold. And even if we look at silver, again, down 6.41% last week. So again, commodities, even industrial and some precious metals are quite suffering due to the headwinds in the dollar and the rates. Watch for this trend to continue until US Treasury yields and the dollar index settle. Looking at DeFi, it was a hell of a week in the DeFi world. First, let's look at the price action. We see that last week, the FTX DeFi index closed down 9.18% at 7,796 points, just above a critical support level here, but it seems to have lost that support level this morning with the recent downturn. Now, looking at Ethereum, we see that it also finished down 10.67 or 10.67% down at $2,242 per Ethereum. And if we look at the headlines, the DeFi spotlight went to a project called Iron Finance and its Titan token, which went from $60 per token to $0 per token. This caused some of its loud and famous supporters to lose what appears to be some serious cash. The incident led to Mark Cuban, as you can see in the article behind me right now. Mark Cuban is the Dallas Mavericks owner, who appears to have lost about $8 million in this Titan token event, according to some reports. Mr. Cuban has essentially, since the event, Mr. Cuban is now calling for regulation around stablecoins. And in his view, it is necessary to define what a stablecoin is and what collateralization is acceptable for these types of tokens. We will see how this plays out, and do remember that there is still a looming potential law out of the US that could regulate anti-money laundering requirements for cryptocurrency transactions. We still don't know how this could impact DeFi. So again, important to stay very attuned to those potential developments around that potential new law. Moving over to our Bitcoin mining difficulty commentary, lots to report on this front. So China, I guess a quick update on what's happening in China around mining right now. So China's concerted efforts to curb mining in the country have resulted in a significant number of miners shutting down and a subsequent large drop in Bitcoin's hash rate. Currently, the hash rate and the difficulty levels are back at January 2021 levels. So as you can see from the article in your screen right now, which I think is a great article if you want to get caught up on what's happening with China and mining. According to the Financial Times, officials all over China are either ordering shutdowns or signaling to local miners in their provinces that their activities must cease. This is in addition to the headline that we just saw this morning about the Agricultural Bank of China basically prohibiting all transactions associated with virtual currency. So it's not really limited to mining. It's going now beyond mining to banking services. Now, if you haven't seen them yet, there are videos circulating around social media depicting a miner in Sichuan, which is a popular mining province in China, shutting down their equipment to a backdrop of very, very sad music. This happened after the province of Sichuan ordered the largest 26 miners, local miners, to stop operating. There is a lot of speculation as to what the intent of this move is by China. Some speculate that it is to stop corruption among local officials and miners for power contracts. Our view is that the main driver for this policy is to prevent capital flight. Miners can build equipment using local currency and get a hard asset that they can trade anywhere worldwide. Anyone who has tried to buy or sell US dollars in China understands how tightly they control their foreign exchange. This represents an excellent opportunity for miners around the world to use this extra revenue to grow. Less miners means that the difficulty drops, so all remaining miners have a higher chance of finding a block, and therefore their average profits should rise until difficulty rises again. Now, as always, we leave you with what's ahead for the week. In last week's meeting, the Fed signaled that it was discussing potentially tapering its bond buying program. This statement set off volatility in the US yield curve and in the markets, all the way from S&P to Bitcoin. The Fed activity continues in the week ahead, and the market will be listening intently as it continues to search for clues. So we're going to give you a quick rundown of what the important activity around the Fed and economic data is this week. So on Tuesday, tomorrow at 10 a.m. Eastern, we get existing home sales. A lower than expected reading will strengthen the Fed's view that inflation is transitory. At 2 p.m. Eastern on Tuesday, we get Jerome Powell, who will be testifying before the U.S. House of Representatives on the Fed's response to the coronavirus pandemic. Look for Powell to address the unemployment situation in his speech. Then on Wednesday, we have Fed Governor Michelle Baumann speaking at 9:10 a.m. Eastern about community development and economic reliance. And later on Wednesday, we get the Manufacturing and Services Purchasing Managers Index at 9:45 a.m. Eastern, as well as new home sales at 10 a.m. Eastern, both very important numbers. Lastly, on Friday, we get Personal Consumption Expenditures Inflation Index. That is a very dear indicator for the Fed, and that comes out at 8:30 a.m. Eastern on Friday. Now, the Fed's projection for PCE inflation, and that is personal consumption expenditures, so personal consumption inflation. The projection for the Fed for this number for 2021 is 4.3%. Now, as I mentioned, this is one of the Fed's favorite indicators, and it will likely show a similar trend to the consumer price index reading that we got for May, which was a rise of 5%. Now, look for markets to cheer a number below 4.3%, and the opposite could happen if we get a number higher than 4.3%. Switching gears from Fed policy to the Bitcoin front. As we highlighted, that large short position that we saw building on Bitfinex last week has covered more than 50% of the open position with the recent move down. This is potentially a good sign, and looking at the price action, that big short position may be looking to close fully in that 30 to 35K range. So we will be monitoring that short position and how it evolves now that we are within that range. So several factors are pointing to the fact that the $30,000 level will be a very important one for Bitcoin. And it will be one to watch during the week ahead. So let's keep an eye on that 30K level. It's a big week coming up as always, so we'll keep you posted with any relevant information right here through the Bitcoin Economic Calendar and through our social media at HODL with Lennon. If you like something, or if you liked our show, if you learned something, I welcome you to share it, subscribe it, and leave us your comments. If you have any feedback or want us to answer any questions, please leave it in the comment section below, and we'll get to it and try to add it into our next episode. If you don't yet have a Ledden account, I welcome you to check out ledden.io and see how you can start earning 6.1% on your Bitcoin and 11% on your USDC. Our loan rates are actually now as low as 9.5% annual, so that is an industry-leading rate. Thank you, everybody. Have a wonderful week, and see you next time.